To my YouTube channel. My name is Michelle Knight and I am the woman behind Little Miss Bookkeeping. Now, have you ever wondered how your individual income tax gets calculated or how the Australian taxation system works? Long story short, the more you earn, the more you get taxed. If you're interested about learning the basics, please keep watching. Tax affects all of us, so it's important to understand how it works. If we didn't pay tax, who would build our schools, our roads, who would run our hospitals? In Australia, our tax works on a sliding scale. Essentially, the more you earn, the more tax you have to pay. In this video, I'll be running through how to calculate your tax as a wage earner or sole trader. You're probably familiar with the term taxable income, but just need a refresh on what that exactly means. Taxable income is the total of your assessable income less allowable deductions. Your taxable income is the amount your tax gets calculated on. Assessable income includes wages, bank interest, earnings on investments, just to give you an idea. Now you can earn up to $18,200 in a financial year without paying any tax. Now this is called the tax-free threshold. The $18,200 tax-free threshold is equivalent to $350 per week, $700 per fortnight, or $1,517 per month. Now, as soon as you go over this tax-free threshold, you do have to start paying tax. Now, moving on to your individual tax rates. So your taxable income will determine which tax bracket you will fall under and ultimately how much tax you'll have to pay for that financial year. So most of us in Australia will fall in the middle bracket, which is total taxable income between about $37,000 to $90,000. This table shows the tax rates for the 2018-19 financial year. So that's the period from 1st of July 2018 to 30th of June 2019. So as I've mentioned, if you earn below the tax-free threshold of $18,200, you will not have to pay any tax on this income. The next tax bracket up, if you earn between the tax-free threshold and $37,000, you'll have to pay 19 cents in the dollar for each of your earnings over $18,200. And then moving up between $37,000 and $90,000, you will pay tax on 32.5 cents in the dollar. Moving up from that, between $90,000 and $180,000, 37 cents in the dollar, and then the top bracket being $180,000 and over, so you essentially pay 45 cents in the dollar plus the $54,097 tax in that. So just to note that these rates do not get included in the Medicare levy, which I'll just touch base next. Medicare levy is an additional tax not included in your individual income tax rates. So essentially the Medicare levy is another 2% on top of your taxable income. Now, Medicare, as you probably know, is access to the government's healthcare system. Now, you may be subject to the Medicare levy surcharge if you are over a certain taxable income threshold and you do not hold private health insurance. So the Medicare levy surcharge is another 1 to 1.5% tax you do have to pay. Now, I'm going to be discussing this in a separate video, but it's just important to understand that if you are a single and your total taxable income for the year is over $90,000, or if you're a couple or family and your total taxable income is over $180,000 a year, you may be subject to the Medicare levy surcharge. You might have heard the term tax withheld, tax withholding, or pay-as-you-go withholding. Now, as an employee, it is up to your employer to withhold any tax on your gross wages. So you will earn a gross wage, your employer will take a small part out for tax and then pay you the rest of it, which is your net wage. It is their job to pay that to the ATO to help cover any tax liability for the year. As someone who is self-employed, it is up to you to withhold your own tax on your contracting or your service income or sale income. Now, when we consider tax withholding, we want to make sure that the correct amount is getting withheld throughout the year. I've seen instances where someone is working 2 jobs and they've completed their TFN declaration wrong. They're claiming the tax-free threshold on both of their workplaces, and what happens is their employer isn't withholding enough tax, which can mean they might have a tax liability or tax bill at the end of the year. So that is definitely something to watch out, and definitely get help from a tax agent, accountant, to make sure you haven't done this, or at least help you figure out what's going on if you're working more than one job. So let's run through a quick example of how to calculate tax on your taxable income. So we have Stella here. She is an employee admin assistant. Her total assessable income, which is made up of gross wages only, is $51,500. She has totaled her allowable deductions of $1,500. So we have our gross wages less our deductions. That gives her a total taxable income for the year of $50,000. Now, when we use the tax table to calculate the tax on her $50,000, her tax equals $7,797. Remembering that we need to add the 2% Medicare levy, which is equivalent to $1,000 in her case. So her total tax calculated is $8,797. Now, it's important to note that your tax payable may be increased or reduced due to a number of things. These include tax offsets, if they're applicable to your situation, pay-as-you-go withholding, so that's the tax paid throughout the year by your employer, pay-as-you-go installments, so if you are self-employed, that's the tax paid throughout the year directly by yourself. Your tax payable may be increased if you have a help debt, or increased or decreased if you have other withholding tax offsets available to you, and if you are considered a resident for tax purposes for only part of the year and not the full year. So because there's so many things to consider when calculating your tax, not everyone is going to be the same. So as you can see, there are a number of things that have to be considered when calculating your total tax for the year. Now, as an accountant, it frustrates me when I have a client come to me and say, oh, I've got a friend or a colleague at work and we earn the same amount, but they got this massive refund and I'm only getting this much, or why is my tax bill payable, etc., etc. Tax in Australia is quite a complex system, and no two people are going to be exactly the same. So, and tax changes between years. So rates go up, rates go down, the legislation is always changing. So you can't rely on a $500 refund last year thinking if I earn exactly the same amount, everything's exactly the same, that's going to happen in the following year. So it's important to understand that you know, things change, circumstances change, you might be able to claim more deductions in this year, less deductions in that year. You know, you can't just compare yourself to someone else without knowing exactly their full, you know, situation. It's going to depend on if you're a single, if you've got a family, a couple, if you've got dependents, a whole range of things. So I hope this video was helpful. Now just remember, the tax legislation is changing all the time in Australia. So if you want to have a go at calculating tax yourself, please remember to check that you're using the current rates. If you have any specific questions around your own tax, please do contact your trusted tax agent or accountant so you're getting the right advice. So if you've enjoyed this video, please give my video a like and subscribe to my channel. It helps me to bring more valuable content to you. Thanks for watching, and I'll see you in the next video.